The Fed stands pat, Facebook will keep investing, and a change at T. Rowe Price. This time on the Morningstar Weekly Wrap. As expected, the Fed held rates steady at their November meeting. The committee did say they were seeing signs that inflation was moving closer to their target and that the case for an increase was strengthening. December seems like a very real possibility for a hike, but far from a sure thing. It will depend on what the data looks like. And as our Jim Sinegal pointed out in a note this week, the glide path of increases will likely be very gradual. We expect the Fed funds rate to be only at 2.25% by 2020. Facebook had another strong quarter of user and revenue growth, but shares were lower on guidance that showed the firm will have to continue to invest in the business. However, this doesn't concern our analyst, Ali Mogharati.
While Facebook surpassed all expectations once again in Q3, top-line growth at the rates that we have seen recently may not continue in the fourth quarter, as the firm faces tougher comparables from fourth quarter of 2015. Now, in addition, to maintain the correct balance of user content and ads in order not to turn away the users, Facebook likely will no longer increase ad load beginning in the middle of 2017. While this will affect revenue growth, it is in line with management's long-term strategy. In the meantime, the company continues to invest in live streaming video content to attract more users and increase time spent on its ecosystem. This likely will help compile more user data through higher user interaction and engagement, which could result in sales of higher-priced ad inventory. However, such an investment, along with others in artificial intelligence and virtual and augmented reality technology, will dampen operating margins slightly in 2017. We expect the firm to begin realizing returns on those investments beginning in 2018 and beyond.
Brian Rogers is stepping down as CIO of T. Rowe Price early next year. Dan Culleton explains what this could mean for fund holders.
We're not worried about the impending retirement of Brian Rogers because T. Rowe has telegraphed this move pretty well since he stepped off of T. Rowe Price Equity Income more than a year ago. Also, the CIOs that are replacing him, taking up his duties, are all very well-qualified, experienced managers that we've known for a long time and have a lot of confidence in. In fact, at least 3 of the managers have either been considered for or won Morningstar Manager of the Year in the past. So, in general, in typical T. Rowe fashion, they've planned this transition very well, and we view this as a way for them to groom the next generation of leaders after Brian Rogers retires. If you own a T. Rowe Price funds, you really don't have to worry about this development. All of the funds are still in very good hands, and this is looks like it's going to be a relatively smooth transition. This move is not going to change our ratings of the parent or of any of the funds.
And in case you missed it, we launched the Morningstar Analyst Rating for ETFs this week and highlighted some of the funds we expect to outperform over time.